take this time that we have right now, and until we have the big economic collapse that I think is coming, if you're interested in the metal to buy your metals, you're going to have lower prices. And don't get frustrated, because as long as you're keeping enough cash liquidity in the bank to cover your bills, you don't have to sell that gold and silver right now. You don't have to worry about lower prices. It's an opportunity for you to get in.
Welcome to Gold Silver Pros.
Hey everybody, this is Rob Kientz with goldsilverpros.com. This is your weekly market wrap-up for Monday, October 2nd, 2023. Welcome to the new month, everybody. We've got Halloween this month. Always one of my favorite times of year. Fall is probably my favorite season just because it cools off here in Texas. But more importantly, we get the changing of the seasons, the changing of the leaves, and also the holiday season is going to begin here pretty soon. So I always really enjoy that. We're going to start off with the stories of the week for you guys, and we've got quite a few of them. The first one I want to talk about as a follow-up to a full presentation we did a few weeks ago is around student loans and the effect it is having on that generation. Student loan payments officially resume after 3-year pause. This is a story according to The Hill. And despite pleadings from advocates, the Biden administration has reactivated payment requirements, The Hill reports. Quote, "It's a sad day for student loan borrowers and for the country that student loans have to come back on, especially with the threat of a looming government shutdown, potentially on the same day. It's just wild," said the president and founder of the Student Debt Crisis Center, Natalia Abrams, apparently unaware that nobody forced anyone to take on all that debt in the first place, according to the article. According to a July survey by Life and My Finances, according to this article, half of borrowers don't make enough to afford their student loan payments, while 22% had a plan on how they would make ends meet once payments resume. Some borrowers are going on a student debt strike and refusing to make payments as a way to show their discontent with the system. Meanwhile, President Biden, who has made a key pledge in his 2020 campaign, has released an on-ramp repayment plan that allows borrowers to miss their monthly payments for the next year with fewer consequences than before. This is something that I talked about when we looked at the research from Morgan Stanley and the Consumer Financial Protection Bureau in our presentation about a month ago. The student loan debt tsunami is here, and it's $1.5 trillion. That's right, $1.5 trillion that's about to hit the economy. This is going to ransack the economy. As these debts don't get paid back, students are going to miss payments. Banks and the servicers are going to be in trouble because they're not going to have money, and you're going to start seeing crashes and that resulting from that sector of the economy as this gets ramped up. Now, this will take a while before the crashes start occurring, but just the fact that 1.5 trillion, about half of that 1.5 trillion, looks like it won't get paid back, and we're not going to have those monthly payments, is going to be a big nail in the coffin of our economy going forward. Also, a companion article by Michael Snyder of the Economic Collapse blog, talking about half of all young adults in the USA are living with their parents. That's right, half of all young adults in the USA are living with their parents. Quote from the article, "These days, about 23 million or 45% of all Americans ages 18 to 29 are living with family, roughly the same level as the 1940s, a time when women were more likely to remain at home until marriage, and men, too, were lingering on family farms in the aftermath of the Great Depression." You read that right, dating back to a time in which women typically got married and men were just recovering from the Great Depression. It's that bad. That's an 80-year mark. Now, neither one of those is true now. Women are out in their workforce getting as many degrees, as many jobs as men in general, at least wanting to do that, and men aren't. We just didn't have a Great Depression where men are trying to find jobs, but maybe we did. Maybe that speaks more to the fact that we have more people in the workforce and less people able to find jobs. Maybe we've been living in a recession this whole time, and maybe it really was as bad as we thought. Another article, a really key one, having to do with somebody pulled a fire alarm to open a door, potentially to disrupt the democratic process. It says here, an article from Zero Hedge, Democratic lawmaker Jamal Brown, a Democrat from New York, from the article, this is a quote, "Thinks we're all idiots after offering an unbelievable excuse after he was caught on CCTV pulling the fire alarm in a House office building while Democrats were trying to delay a House vote on the stopgap bill, which eventually passed at 11th hour. The Democrats, supposedly from this article, were trying to figure out what's in the bill and trying not to pass it until they knew. And so the thesis of this article is, or what he supposes, is that he pulled the fire alarm so they would have time to do that. Bowman, who founded a school that would have held several fire drills per year, the article notes, wants us to believe he mistook this fire alarm, and it's a normal fire alarm on the wall, for an automatic door opener, which is not the same thing. And it's got a picture here basically showing that it says emergency exit only, fire alarm. You couldn't have missed it. In a Saturday statement, Bowman said, I want to personally clear up confusion surrounding today's events, adding, today, as I was rushing to make a vote, I came to a door that is usually opened, which it's not, as the signage clearly states. I'm embarrassed to admit that I activated the fire alarm, mistakenly thinking it would open the door. The article goes on to note that there are tunnels that people normally follow to get to where they need to go, and they don't have to use an outside access door. The level of gamesmanship and the level of corruption within our political system is rising. And I think this has everything to do with what's going on fiscally, economically in the country. As the economy goes, so too does politics and culture. I've talked a lot about culture before with riots and things like that. And in politics, we're having this kind of goofy stuff go on. This is not emblematic or representative, I guess I should say, of where politics used to be in the United States. And more than anything, rather than picking on Democrats or Republicans, it's just a sad state of affairs that's going on. But that's what happens when you're fighting for money to keep the government open and you have all these political games. At the end of the day, we have a short-term approval for enough funds to keep the government open for about another month or so into November. The question is, will they be able to continue funding the government as we go forward? As I was in the airport heading to a conference this past weekend, there were people in the airport lamenting the fact that they may lose their jobs or at least not have money to pay the bills. And they're living paycheck to paycheck, as most Americans are. This would be devastating for people that rely on that. But even getting beyond that to the bigger term picture, is the government so big that now we cannot fund it anymore? That the fiat system, as it collapses, we're not going to have enough money to pay the government, much less all the kids that are also living at home and not finding jobs, not getting married and having kids and all of that. It seems as though we're heading closer and closer to that collapse. Moving over to the weather side, U.S. meteorological analyst and YouTuber Ryan Hall said in a video published on Saturday, quote, winter in the U.S. this year is going to be very different. El Nino is ramping up in the Pacific. Sea surface temperatures in the Atlantic Ocean are still off the charts, and we're going to have an amplified southern jet stream. What that basically means is the first snowfall has been predicted for today in the upper parts, especially the upper Midwest, northwestern Midwest of the United States. But that as far south as Texas, where I live, by December 30th, could get heavy snowfall. We're expected to see very, very heavy snowfall this year, according to him. And also, the Farmer's Almanac is also predicting, and an August weather note, quote, the burr is coming back. We expect more snow and low temperatures nationwide. The middle of the map, coming all the way down to Texas, including South Texas, is unseasonably cold, stormy, wintry temps in the west, including California, and in the east, including Florida, chilled, wet, cold, and stormy, while the upper reaches of the United States expect to get absolutely slammed. We're going to have a major weather event coming to the United States, and that's going to be big. I think it's going to raise energy prices, and it's not going to make things easy. Remember, when we have big weather events, it affects the economy, and it also affects people's pay, and it affects utility bills and things like that. If we have a really big weather event this winter, and we've got kids that can't work, and we have government shutdowns and people that can't pay their bills, the question is how many people are going to suffer, maybe how many people will die in the weather events. Hopefully, we hope not too many, but we'll have to see what occurs. Next, we're going to get into the economic data to know. Here is your economic data to know from the previous week. In housing, new home sales crashed 64,000 down to 675,000 overall. That's down almost 10%. Also, pending home sales crashed 8% month over month, down to a negative 7.1%. The housing market is crashing. As I predicted about 2 to 3 weeks ago in a presentation on housing, I said this is going to come. Some people were telling me that we needed more housing and the housing market would continue to grow. I said, no, we're going to need more affordable housing, and people cannot afford it at existing rates. Not only that, but they can't afford to buy houses, period. And that's why the housing market is crashing right now. In consumer inflation and wages, personal income is up 0.2%, which is nice. But PCE inflation, the internal government measure for inflation, is also up 0.2%. So net consumers gained nothing, even though their wages went up. The trade deficit dropped 7.3%, while inventories rose 1.1%. That sounds good, except for the fact that if we are buying less, which is why the trade deficit dropped. It means we can afford less. And while inventories rise domestically, that means wholesalers and retailers are selling less. That's an indication the consumer is not buying as much. Both of those data points actually point to that fact. Case-Shiller home prices rise 0.1%. It's going to be a key component of the inflation that is up. And the consumer confidence index crashes 5.7 points to 103. Consumers cannot pay the bills. They're not as confident about the economy going forward. On the business side, the Chicago Business Barometer dropped 4.6 points to 44.1, meaning that in that part of the country, they don't expect business to increase but decrease. Of course, we know the political issues and the tax issues that are going on in Chicago. They've talked about taxing all financial transactions, potentially pushing that sector of the market completely out of that region of the country. As the financial sector over there said, we will not do business here. Things in Chicago are getting really nasty right now. Wholesale inventories across the country dropped 0.1%. Because wholesale will drop when retail drops first. If retail signals that they're not buying things, wholesalers will begin to cut back. We're starting to see that. Durable goods orders are up 5.4%. But according to the news, it's largely on war spending for Ukraine, according to MarketWatch, meaning the only thing that's causing us to spend more money is on the war, not on consumer purchases domestically. I wanted to make that point very clear. Some purchases are up. It's on international spending for the war, not on consumer spending. In jobs, we got the report that initial jobless claims are up 2,000 to 204,000. That is not a positive number, as we have more jobless. Moving over to the markets, we can see here what is going on in the markets today as of about 2 p.m. Central Time. The stock market is red across the sector to open the week. All of the major indexes are down. The Dow itself loses 200 points as government avoids a short-term shutdown, but there's no long-term solution in place. The markets aren't happy about that. The Russell Small Cap Index officially negative for the year 2003, not just this month, but for the entire year. As small caps go, typically do jobs go, because smaller companies create most of the jobs. And that is a huge indicator that we're in recession when you look at the other data along with it, including jobless claims, the consumers living at home and not finding jobs, and the wages not increasing to keep up with inflation. On the bond side, the 10-2-year yield curve inversion increases to 0.423 percentage points. Bond rates overall are up. The 10-year pops up to 5.002%. It's up above 5% again, indicating more risk in the economy. Corporate high yield debt is up 3.86%. Muni bonds are up 5.08%. Mortgage-backed securities are down 5.09%, and regular corporate down 1.29%. Most of the bond market is signaling increased risk with the higher rates. And crypto, Bitcoin is up 700 points today to 27,804. Ethereum is down 15.87 to 1660. Litecoin down 0.41 to 6602. That is basically indicating that in a risk on environment, Bitcoin is the preferred of the cryptos of all the major crypto types, and it is the lead in the original one, and that makes complete sense. The other ones are down a little bit on the negative news, but as we go closer to recession, I expect Ethereum and Litecoin probably to continue to go up as well. Next, we're going to get on to the gold and silver report and give you all of the data on that part of the market. All right, here you have the current gold and silver prices as we're recording the video. Gold is down $18 to 1830.39. Silver is down 93 cents to 21.18. Getting a lot of interest in gold and silver in my store today as the prices have started falling. We're going to get into the charts and tell you what's going on specifically with gold and silver. On the gold chart, as you can see here, elevated volume here to begin to end September and to begin October, which is normal because you're going to have some deliveries in October. But overall, the interest is up as the price falls. That tells me more shorts are entering the market. We'll get to that in the COT report here in a moment. But looking at deliveries here, the October month, we've already had 3,337 deliveries for Friday, September 29th, one of the first delivery days. I believe for the month, we're up to almost 4,000 and some deliveries on the month. We can also see that the exchange for physical over to London from the December month, where you can't deliver currently in the December month, but you can take that COMEX contract and go over to London and see if you can get delivery there, is at 5,164 for Friday's data. And I like to do this over multiple days to show you there is a crap ton of demand moving from COMEX to other markets, because not every month on the COMEX is deliverable. About 6 months are going to be somewhat heavy delivery in gold and in silver every year on the COMEX, about half of the months, even though the paper trades all the time. So in a light month like September, October, November, which have lower overall open interest, as you can see the numbers here, what's going to happen is people are going to take their COMEX contract in the big futures month, December, try to pull it forward a couple of months and see if they can get delivery here in October. So if we look at Thursday's data, we had an additional 7,266 contracts of 100-ounce gold move over to London. We look at Wednesday's data, we're 11,464. That is one of the largest prints I have seen all year on a single day. 11,464 gold contracts are being pulled off of the December COMEX market into London, seeking physical delivery of the metal. They want the physical. The market wants the physical now. 7,865 last Tuesday. Last Monday, 6,993. An immense amount of demand for physical gold is going on in the markets. I cannot possibly stress that enough. You can only get a modest amount of deliveries in a month where it doesn't have a lot of contracts, but you can take it over to London fishing for that gold. Let's look at the settlement data. As of Monday, 1:32 p.m., you'll get that midday quote. It's why I wait to do this market wrap-up until after that quote, because we can see what's going on Monday. And the December contract is a dominant one. You can see a volume of 181,000 contracts. For those that have never watched the market wrap before, what that means is this is a futures market. They're trading the potential future prices. So you'll take a futures contract to a futures month or a contract to a futures month. And while you take delivery only in the current month, you're playing the prices several months out because you're trying to offset risk if you're a producer or merchant of dealing with the physical, or if you're a speculator, you're just trying to take money on what everybody else is doing, take a position and try to snipe that or take some money off of that on a futures contract in the future. So we saw that gold is down $18.90 today on early trading. Of course, it's done a little bit better here after 1:30, but overall very bearish on gold. That's why the slam down. Going back to Friday's data, that was down $12.50 on the December contract. And on Thursday, it was down $12.30. And on Wednesday, it was down $29. And on Tuesday, it was down 16. So all of last week was incredibly bearish on the gold market. Now, remember, the futures market is where the prices are determined, not the physical trade. The futures market. So this is paper trading, not the physical. So it's not indicative of the overall physical demand. I just told you where the physical demand was very high. People are trying to get gold. A lot of times to cover that physical demand, the shorters will come in and short the market to keep the prices down, so then they get that physical very cheaply. Moving over to silver, looking at the volume and open interest on the day, we've got elevated through the end of September as we prepare for deliveries in October. We've had 124 deliveries on the October contract, but look at where we are in exchange for physical. 775 contracts as of Friday's data of 5,000-ounce silver went over to London. On Thursday, it was 250 contracts. On Wednesday, it was 906 contracts. On Tuesday, it was 790. And on Monday, it was 227. Now you're seeing less contracts of silver go to London seeking out the physical. One reason is because each contract in silver is 5,000 ounces, whereas each contract in gold is only 100. So you need less contracts to control silver. But while industrial demand is very heavy in silver, the monetary demand for gold is off the charts, which is why you're seeing high exchange for physical numbers each day, because people are going to gold. Why do people go to gold? Gold is the almost purest play for when you go to a recession and you think there's going to be currency problems, you think there's going to be economic problems, everybody rushes to gold. It's the biggest safe haven. Silver, for the most part, most of the time trades as a commodity used in all the things that we use, technology, military, medical, and then silver will jump up when people treat it as money. Right now, gold is leading the way, which tells me risk is on in the market. People are afraid and they're going to gold big time. As we look at the commitment trader report, the COT from the CFTC, the regulator. Now, remember, these are always done in arrears, and that's counting term, which means in the past, because it always takes them 7 to 10 days to compile and print the data, but at least it gives us an idea who's shorting the market. The swap dealers you can see right here are the bullion banks, the biggest, longest 4 traders. As you look at by gross position, 4 largest traders are 34% short. That's all in the swap dealer category. Why? Because you look at the overall numbers. So the bullion banks hold most of the shorts, 196,295 contracts as of the current COT report. and that leads to 34% or about 1/3 of the overall short position. The banks do this all the time to keep the market short, to keep the prices down. There's no other explanation. They're not doing this just for the producers and merchants, because the producers and merchants, as you can see here, have their own category, and they've got 39,000 of their own shorts. So the swap dealers aren't just doing it on behalf of the market. They're doing it also for private clients and for their own house account. We know that. They did most of the shorting, almost 14,000 contracts in this COT report. The other side, the managed money, took the shorts. They believed that the prices were going, they released their shorts to swap dealers and they switched it over to the managed money. The managed money took the shorts, and that's what's driving the price down. Excuse me, this is backwards of the normal trade. And I think because the swap dealers think that gold is going to go long here in the future, so they're adding longs and cutting their shorts and moving those over to the managed money. Right now, the managed money is going to make a little bit of money on the trade, but I think what's going to happen is swap dealers are going to flip and go back to shorting gold so they can get the gold off of the market. But as long as they have enough short positions in there, they can get the gold off of the market cheaply. Over in silver, as we move up into the silver section of the report, this is silver. We see that the swap dealers went additional short 2,374 silver contracts while the managed money released those. So basically, managed money went net long, swap dealers went net short. That's where the shorting in the silver is coming. I believe the swap dealers are shorting silver to keep it from rising too much, primarily for industrial reasons, but also because if you keep silver down, that keeps a lot of investors, a lot of silver stackers frustrated at the market, and it keeps that silver flowing to industry at cheap prices, which they need. We're in silver shortage condition. Overall, the mines cannot produce enough, and I think that's what's going on. Very interesting action in the COT report. It's a little bit different what you may see, but it does explain why the short pressure on both of the commodities as we head into the fall. I don't think that's going to last forever, because I think eventually, given the economic problems, gold and silver will rise, but probably we're going to get a sell-off first, because silver and gold did very well during the summer, and some people need to liquidate those positions to gin up money in the system to shore up their balance sheets as we head into recession. So gold and silver may fall a little bit this fall until we get some negative news, and then they shoot back up. If we go into recession, gold and silver will fall for a certain period of time, probably a couple of 3 weeks, maybe even a month, before shooting back up in a big way. And a lot of that action, to explain what goes on, essentially what happens is the markets are playing short-term price movements 2 to 3 months at a time. And a lot of times they'll short either to get access to the metal or to short to take profits and set up the next position. But whenever you get negative news or you get a big recession, that long comes in big time and will raise that price for a while. We saw that in May of this year after the bank failures. And then after the government acted and the risk of bank failures went down, at least in the short term, the prices of gold and silver both faded a little bit over the summer, and now they're being smashed. But I think they're being smashed in preparation for, one, getting liquidity for people that are playing on the market for what's coming in the recession. I think that's what's going on now. Looking at the deliveries on COMEX 100 gold futures, you can see robust deliveries all year long. Typically in gold, you'll see one big month followed by one small month, followed by one big month and one small month, and you're seeing that. In January, 6,610 contracts delivered, and then in February, 15,000. In March, 6,132. In April, 24,000. In May, 6,140. In June, 20,690. In July, 3,308. In August, 12,272. In September, 49,13. October will be bigger, although December, I think, is going to be the biggest one of them all. You saw last December, 20,000 contracts were delivered physically, meaning physical gold was at least taken out of the registered category and changed hands on the COMEX. But we've also seen the chart where gold and silver are flowing out of the exchanges. I'll show you that in a moment. So it's not just as it's changing hands on the COMEX, it's actually coming out of the COMEX, and that's in the chart I'm about to show you. These numbers overall, however, from a monthly basis, are some of the highest on a monthly basis that I've seen since I've been covering this report in detail for the last 5 years. I've been covering this report for 5 straight years, talking about this. These are some of the highest numbers. The amount of deliveries coming off of the COMEX is astounding in both gold and silver. We're going to come down to the silver market down here, and we'll look at the same thing in terms of yearly deliveries on silver. It's not quite as high as a gold in terms of a percentage of the market, but you still see stuff coming off. Here are the summary numbers for silver. Again, it's that pattern of high one month, a little bit lower the next month, because remember, not every delivery month is big. So about 6 months are going to be pretty high. But overall, a lot of silver is coming off the market as well. And I think that's indicative of the industrial demand. All right, moving over to the ETFs. this is where you see the gold flowing off. In every single category from registered to eligible on the COMEX, we've seen gold taken off the last 4 weeks. It's not just deliveries that sit in the warehouse, it's coming out of the warehouse, and that's what all the red numbers are. Even when you add up all the stuff sitting in London, which is most of these ETFs, it's red all over the place to the tune of 2.5 million ounces over the last month. And you can see all the gold ounces held across the world in these repositories and ETFs has been coming down, and it spiked right about midway through the year. As prices began to fall in the summer, more gold got taken off. Again, what did I say? The shorting covers gold being taken off the market. When they short the price, they can get it cheaper, they take it off. That's what this little baby part of the chart is. The prices started to fall a little bit in the summer, and now they're being basically monkey hammered. And that's when they pull the gold off because they get it cheaper. Same thing in silver. We're going to go up and click on silver. You're going to see a very similar dynamic. Overall, a lot of silver ounces coming off the COMEX, some flowing into London via the SLV, but overall still coming off of the London market net as well. 8.7 million ounces in the last 4 weeks came off of the US and the UK markets. And again, you can see that being pulled off the market over time. Regardless of where the silver price is, the ounces are coming off. And that's basically why they hammer down the prices so they can get it cheaper, whether it be for industrial use or for investment use. Okay, last chart of the day. We're going to go over to the Shanghai. I've been covering the fact that the Shanghai delivers a higher percentage of gold per month than the COMEX. The Shanghai, every time I look at it, is about 76 to 77% of contracts are physically delivered. If you look at how many contracts are delivered on the COMEX, deliveries for Friday were 0 to the tune of 375,000 contracts trading. So a very small percentage of the futures contracts traded on the COMEX ever get delivered, but the majority get delivered in Shanghai. And I think you get more of a true gold price because there's more deliveries, meaning the actual physical demand is more represented. And you can see the difference in price between the COMEX and the Shanghai is $58 on basically equivalent size contracts. So gold right now on the industrial exchange in China is $58, and this is as of Friday. Given the price smash we had today, it's probably a lot more. We'll get that data tomorrow. But gold trades much higher in China at the big volume industrial level than it does in the US because it doesn't get shorted as much in those markets, and we see more how the physical deliveries affect the overall price. When you're looking more at physical deliveries and less on that paper trade in Shanghai versus the US, you get more of a true price in gold, and it's much higher. I think that's the overall direction gold's going to go, because look at all the gold and silver too, because look at all the gold and silver coming off the market. Now you can continue to issue that short paper in as many thousands or hundreds of thousands of contracts that you want, but eventually the piper has to be paid, because I showed you that the metal's coming off. And if we get into a shortage condition, as I said this weekend at Silver Symposium, the prices are going to go limit up. You're going to see maybe even a stoppage of markets if it gets bad enough. Now, if the economic data continues to get bad as it is, we've seen the return of inflation. We're seeing deflation in housing sales, even though we still have rising prices. We're seeing deflation in economic activity that I cover at the beginning of this presentation, in the stories and economic data. Gold and silver, the reasons gold and silver need to go up are putting pressure on that market. And they can sit here and hammer it with paper all day long. But eventually, when you get shortages, the price is going to go up. And remember the dynamics of how that works. I'll restate it one more time. They can monkey hammer the prices down. That just causes people to take more physical off. People are doing that because to get the physical off and also to get access to liquidity so that they can cover losses in other paper markets. But the big boom comes when we hit an official recession after that initial sell-off, and the physical demand is so positive that eventually the contract paper trade catches up to it and those prices rise. That's almost always a dynamic in a recessionary event. So just because the prices are low right now, do not get discouraged. This is sort of the calm before the storm in terms of prices going up. Some of it's repositioning from futures trades into others because net, a few less overall contracts are trading in that futures market. They're pulling money out to go cover losses elsewhere. But if we get into a recession, those prices are going to rise because physical demand is going to explode, and the traders are going to see it and they're going to say, wait, physical demand is exploding. We're going to bid that price up. That's almost always. So take this time that we have right now, and until we have the big economic collapse that I think is coming, if you're interested in the metal to buy your metals, you're going to have lower prices. And don't get frustrated, because as long as you're keeping enough cash liquidity in the bank to cover your bills, you don't have to sell that gold and silver right now. You don't have to worry about lower prices. It's an opportunity for you to get in. But remember what happened in May of this year when we had bank failures. Gold and silver, boom, Remember what happened during the pandemic in 2020 when we had shutdowns, gold and silver, boom. Remember what happened in 2008, right after the 2008-2009 recession, from 2009-2011, gold and silver, boom. What happened during the tech crisis in 2000 when we had the sell-off in the tech sector, gold and silver, boom. It happens every time we get into one of these economic crises. I think everybody believes we're going to economic crisis, or gold and silver will rise. Don't get discouraged in that trade. That's my recommendation. That's going to do it for the weekly market wrap up for this week. Thank you, everybody, for tuning in. I'm your host, Rob Kientz with goldsilverpros.com. We're trying to rearrange this and bring you more information, make it a little bit longer, and increase the presentation value and sort of structure the information in a way that you can absorb it and help you out, understanding what's going on in the economy, and position yourself however you're doing your own trades in the economy and your own buys. Hopefully this gives you the information that you need. Stay tuned to the channel. We've got a great presentation for this Thursday. I'm going to give you the presentation basically that I gave at Silver Symposium this last weekend. There were 800 of you at Silver Symposium this past weekend. I got to speak to a lot of you when I asked the crowd to raise their hands as to how many had traveled to Vegas. It was about 90%. People are coming from all around the country to go to Silver Symposium. That's a good sign. People are very interested in the precious metals. And I think that means that we're going to have a very robust market. Well, I'm going to give that presentation to everybody else. I've got almost 100,000 followers across all of our social media. So I'll get that out to the wider social media base, and I'll explain the significance of what I'm talking about there. That's going to be about ways to get into the gold market and an analog the silver market, even though I focus on gold. Ways that you get in and ways that you can get value there may not be what you think it is, but I've got lots of charts to show you how it actually works. It's going to be a good teaching session for you guys that I can give in about 30 minutes. It's going to help you collect research and information for your own precious metals investing journey. Stay tuned to Thursday. It's going to be a great presentation. Until next time, this is Rob Kientz, goldsilverpros.com.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our Gold Silver Pro supporter membership. We appreciate your support. Keep stacking.